and we are looking at a screen which has not been looking good for the last couple of days. Well, for what it's worth, we started off okay yesterday, but from there was that sellout that happened in the second half, and by the end of the trading session we were at the lowest point. This morning when we start off the day, it is not looking a very pretty screen. The global cues are not supportive at all. Yesterday we saw one of the biggest declines that the Dow has seen since early September, and one of the reason is that there was a lot of action when it comes to the money market. The US 10-year yield has jumped to the level of 4.25%. If you look at the dollar index, that's at 104.5, 105 thereabouts. And there is a bit of a pressure when it comes to the equity market. So if you look at the US markets, Dow Jones was down 400 points, Nasdaq was down 1.6%, a 300-point cut coming in there. So not a pretty looking screen. Nikunj, of course, domestic factors haven't been anything to write home about. And now if you look at the global cues as well, it's just going to add to the pressure.
So, Nisha, the question you got to ask yourself is that, is there a pause in global cues? Is there a reversal in global cues? There is a difference. The pause in global cues could be a function of the fact that in the last couple of days, US markets, Western markets, they've done well for themselves. I think it's a pause because I don't think the big picture in terms of where the interest rates in US are moving, the kind of indications which we've got from US tech companies, the commentary from Nvidia, the concerns which were centered around the China comeback trade and escalation of Middle East crisis, all those concerns in a sense is something markets have digested. As of now, it appears to me that last night's price action in the US market was more like a routine kind of a shift, which is volatility went up, yields they went up, and we saw a mild profit booking in major indices. But you're absolutely right. I mean, when we were getting compressed because of global cues, because of local factors and liquidity related factors, suddenly there is going to be a global angle to the market weakness. So while the global picture in a sense was intact, which was one worry less, but more than global today, I think the pressure point, at least in the morning, would be coming from global markets.
Right, absolutely. Talking about the global markets and like the way how Anisha also summarized the fact that the US markets ended in the negative territory. You also have the 10-year treasury yields that are at 3-month high, and that sort of added the pressure in the global markets. But back home, we also shut shop a week in yesterday's trading session. No doubt we saw that midday rebound in the markets, but we ended on the weak footing. Once again, you had Nifty that failed to hold on to 24,500 mark. You had the IT sector also cave in. You had the financials also that put in pressure once again. And all the commentary right now is surrounding on earnings and the way how the Indian markets are performing on back of that as well, right, Nikunj?
Sure. We are underperforming, and we are underperforming largely because of 2 or 3 factors. Factor number 1 is earnings are not great, and markets were not expecting such a poor display and such a such a poor commentary. So earnings are not great. You can go all the way back to Reliance and Nestle, then throw in the kind of indications which we got from Tata Consumer. We did not get anything big or special from Kotak Mahindra Bank, or for that matter HDFC Bank. So the market positioning largely seems to be changing because of earnings and the fact that we've not seen any huge pickup in demand per se. Second is the HNI crowd, which in a sense was purely playing momentum. Well, guess what? The mood and the momentum, they both have changed. If one really looks at the FI versus DI data, which is what you really need to look at, because everybody is of the view that FIs are selling and DIs have stopped buying. Last 2 days, and the number you want to remember here, folks, stay with me, is yesterday's FI data, 5,600 crore, right? That's yesterday's data. Turn it with yesterday's DI data, it will just come up on your screen, and it is actually net positive. So even though the net institutional activity is positive, hardly any short positions were created, then why are markets down? That is because the mood and the momentum, they both have changed. There was a mass section in the market which was chasing price, not valuations. They were not buying businesses. They were in a sense chasing momentum. That entire trade has reversed. I don't think everything deserves to fall the way it has fallen. Just like I was maintaining in September and early October that everything does not deserve to go up the way it was going up. So that is financial market for you. It was a rising tide phenomenon which took everything up, and it was a receding tide phenomenon which seems to be bringing everything down. So now that we've identified what has gone wrong, let's look at where we are headed. I think the where is more important than what. What do you guys think?
Well, hopefully a bottom soon. That's what we want to see, that perhaps at 24 at least there's some semblance of recovery. Maybe the overheated sectors, the PSUs, etc. might stay a bit sideways. But maybe the banks which have corrected quite a bit, they might recover a bit.
What do you think, Cheryl?
I don't know. It looks like that we are in for a little weaker market footing, looks like it at this point in time, because we're hoping that the selling stops, but it's unabated.
Okay, markets are down largely because the mood and momentum has changed and earnings have disappointed. If prices they improve, mood and momentum can change again, right? Which is negative could become positive and positive could become negative. So I think the out of jail card for the market really would be, one is that we get decent update from banks which are not due to come out with their numbers, and adding to that could be some indication from festive demand. B, we get further indication from government that they are committed to take care of the budget targets, and in the second half of this year we get a huge fillip when it comes to the government capex. Third, we don't have any large IPOs. Hyundai, that's it. Vari was not very large. Swiggy, I don't know when it is coming, which means that in the near term, post Diwali, once the listing is done, once adjustment is done, hopefully market, there will be no liquidity vacuum per se. But in this market now, I think another 2-3% down on the Nifty, another 5% down on the stock, it's time to start buying. I would stick my neck out and say that it's time to start buying into banks. There's a trade coming in some of the beaten down PSUs. Power and energy transition, I think, is a real deal and it is here to stay. I feel that any market cycle always bottoms out when the consumer companies, they put their hand up in the air and they start shouting for a slowdown. Because in India, the wealth effect is very large, right? What is the balance sheet of India? Indians.
Correct.
Real estate, stocks and gold. All these assets are at an all-time high. So it's not that the wealth effect has been knocked out, right? The wealth is there. It's just that because demand has slowed down because of external factors, I think it could take another quarter or so before it starts coming back. The effect of good monsoon, the base effect of last year, the wealth effect directly, indirectly, all that will start coming back. So I think this could be the worst quarter, or maybe the coming quarter could be the worst quarter. So you will see this market going through a grind and time-wise correction, and within that, when this kind of a market action starts, when everything goes up in a synchronized manner, when everything falls in a synchronized manner, synchronized is the word. When everything goes up in a synchronized manner, time to book profits. When everything comes down in a synchronized manner, time to start buying. So I think you should keep your list ready.
Keep your list ready, but would you, stick your neck out and say that it's the year we are going to see Santa Claus rally yet again? And I ask you that because last year we got it really right when we were talking about Santa Claus rally from a long time ahead. This time things are looking a bit iffy. Do you think it's going to come back very soon, or it's going to be a bit of a gradual up move?
See, last year the Santa Claus rally was easy to guess.
Yeah.
It was easy to guess because you knew that China was, in a sense, had become the sick man of the world. You knew that there was no large inflows which were moving away. You knew that interest rates globally had peaked out, and flows had to come back to emerging markets, and Indian markets were enjoying what really could be called as the entire earnings upgrade cycle. That is not there. The earnings upgrade cycle is missing. China, the flows, whether we like it or we don't like it, flows are going there. And see, there is nothing in the short term which will also generate upside momentum. What also aided to the Santa Claus rally, ladies, was the fact that there was a state election which happened in December. Correct. And the outcome of that state election comforted the market a lot. So there was earnings upgrade, there was state election, and there was no China. Right now we have none of that falling.
We do have a couple of state elections, and important one.
That was a different framework. Why? Because that state election was ahead of the central election. That was more like a semi-final match.
Yeah.
You have the opposite right now. You don't have a catalyst. You don't have earnings with you, and you don't have and you have the China fear factor, which is a real deal. So to assume that we are in for a last hurrah or the final flush is still left, I think may not be true for Nifty. But there are a lot of stocks, trust me. I mean, 30-40% stocks fall. You should be looking at options to buy rather than shying away. That's my point in mid-cap stocks now.
Right. Given the fact, the way how the markets are actually looking at this point in time, make sure that your shopping list is at least ready. But there are a lot of other factors actually to watch out for. Like we mentioned that you have had earnings also that have come out. You have the F&O setup. If you look at the F&O setup, the way how the setup is looking like at this point in time. But let's put the spotlight of FMCG companies, because if you look at the FMCG companies, the roundup has not been that great. Though HUL was in line, you had Tata Consumer that gave a mixed earnings, you had Nestle that had a miss in their earnings. And Nikunj did speak about the fact of how the FMCG sector and their earnings are going to look like. But Nikunj, if you talk about the way how the setup has been for the markets, everyone's betting that someday or the other you will have the banks that will outperform. But do you think that it is going to be sooner than later that the banks will also start performing in this markets?
See, the comeback in bank we've discussed from last 2 years, it's not happened. And it is something which has, the comeback in banks I think is overdue now. And I'll give you a lot of factors here. You look at the initial set of banks. Everybody knows that banks have a problem in terms of liability. But everybody is also aware of the fact that there is no large NPAs, at least with any of the large private banks. See, because the market is slowing down and the aggregate Nifty numbers will even struggle to be 10% for this year, suddenly next year banks have a promise of giving you a growth rate which is higher than the Nifty number. So, you know, 15% growth when everything is growing at 30% looks bad. But when everything is growing at 7-8%, a 12-13% growth from banks will look better. And that will automatically happen because of this year's base effect will kick in next year. And fourth, I think 3-4 years if banks have consolidated, that means the time-wise consolidation and the price-wise consolidation has happened. I don't know when will banks come back, but I am reasonably confident that from here till next 1 year or next 12 to next 18 months, banks will definitely outperform the Nifty. That could be a combination of large private banks, it could be a combination of mid-tier banks, but banks is where the excitement is happening. See, we got the financial theme right. And look at AMCs, look at CDSL, look at BSE. So the financial theme has worked very well. It is just that financials mein banks have not done well. So if that entire theme is moving, it's a matter of time financials will do well, because AMCs are at an all-time high. I mean, CDSL is at an all-time high. Brokerages are doing very well for themselves. They are at crazy valuation. Motilal Oswal Securities, look at the numbers. So I think all that put together means that the financial theme is alive.
Financialization of savings is definitely alive, and yes, you keep on seeing that, SEBI etc. keep on coming out with norms that might lead to curbing of derivatives etc. But these brokerages continue to do quite well. That was about banks, but I want to come back to you, Nikunj, on FMCG, because the kind of earnings that we have seen this quarter haven't been really that great. I mean, if you hear the commentary coming in from Nestle management, they talked about how urban areas are slowing down. Ditto exactly came in from HUL, and you of course had that longish conversation with Tata Consumers management, and they also were saying hopefully there will be a recovery, but not willing to call it.
And this is happening when everybody was convinced that the monsoon effect would kick in.
Exactly, and elections, post-election,
and election spending would kick in, yes. And the government will be far more cognizant in terms of taking care of what really could be called as the bottom of the pyramid, because they got hit even when it came to the political mandate. But none of that assumption of the market has translated into reality. The call you got to ask yourself is that what else could go wrong? Are there pressure points in the next 2 quarters which will have an impact on demand? Which is that, will inflation come back? Will there be something large in terms of a price disruption or a demand or a income, income generation which will stop? The answer to that is no. So I definitely feel that if not this quarter, the coming quarter, I think these numbers will start bottoming out, because the consumer sales always bottom out, and that the last to bottom out, especially when it comes to categories which essentially are got to do with food, beverages and other things. So I think the slowdown has surprised us, but I remain reasonably confident because the base effect of inflation will kick in, competition is not intensifying, price wars are getting over. All that will lead to better margins and better demand vectors in coming quarters.
Right. So
there comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.